Hello and welcome back to our webcast series on connectivity between IFRS accounting and IFRS sustainability. We have a joint team of IASB and ISSB presenters for this series. My name is Gabriel Benedict, and I'm a part of the ISSB technical staff.
And my name is Gustavo Olinda, and I'm part of the IASB technical staff.
This is episode 4 of our webcast series. As explained in our first episode, in episodes 2 to 4, we will walk you through a series of examples where we will look at the reporting outcomes of applying both sets of our standards together. We have prepared these examples to illustrate how applying IFRS standards together as a package results in connected and complementary reported information. Our examples for this series are focused on climate. As shown on this slide, the examples cover 3 topics: climate-related risks and impairment of non-financial assets, climate-related opportunities and changes in product mix, and climate-related commitments. In this episode, we will cover our final example, which is about climate-related commitments. Before watching this episode, we invite you to watch episode 1, in which we provide a theory refresher and explain how our standards are designed to work together. Now, we have a few housekeeping points that apply to all of our examples as we explain on this slide. We would like to emphasize that these examples are basic illustrations of how IFRS standards work to support complementary and connected information. The examples do not illustrate all requirements in IFRS standards, nor do they provide a complete set of illustrative disclosures. From the ISSB standards perspective, we will focus on 2 areas. Firstly, we will illustrate how disclosures about the current and anticipated financial effects of sustainability-related risks and opportunities expands on and complements the information in the financial statements. Secondly, we will focus on other disclosure requirements in the ISSB standards that are of particular interest in the fact patterns discussed in illustrating complementary and connected information with the related financial statements. The examples follow a consistent structure. We will first discuss the information reported in the financial statements, followed by information reported in sustainability-related financial disclosures. When we talk about information in the financial statements related to the climate-related risks and opportunities described in the fact pattern, we will consider, first, whether there is an effect on the recognition and measurement of assets, liabilities, equity, income, and expenses. So is there an actual effect on the amounts reported in the financial statements? And second, if recognition and measurement are affected, whether disaggregated information about those effects is provided in the financial statements. So is that effect visible in the financial statements? And finally, the examples will consider what other related disclosures are provided in the financial statements. As mentioned before, in discussing information reported in the sustainability-related financial disclosures, we will focus on current and anticipated financial effects related to climate-related risk or opportunity, and the disclosure requirements that are of particular interest in the fact patterns discussed in illustrating complementary and connected information with the related financial statements.
So let's move on to our example on climate-related commitments, our last example for this webcast series. Many of you will be familiar with this fact pattern. It is based on the agenda decision on climate-related commitments published by the IFRS Interpretations Committee in April 2024. We chose this fact pattern because it is a particularly good example of how sustainability-related financial disclosures would complement the information in financial statements. So moving on to the fact pattern. In 20x0, an entity commits to reduce its Scope 1 and Scope 2 greenhouse gas emissions by 60% by 20x9. The entity plans to achieve that reduction by modifying its manufacturing methods, including purchasing energy-efficient equipment. The entity also commits to offset any remaining Scope 1 and Scope 2 greenhouse gas emissions from 20x9 by buying and retiring carbon credits. We will now look at what the entity would report in 2 reporting periods. In 20x0, when the entity first makes its climate-related commitments, and in 20x5, after the entity has started to modify its manufacturing methods and to purchase the energy-efficient equipment. As explained in the agenda decision on climate-related commitments, when the entity first states its commitments in 20X0, it does not recognize a provision for that commitment in its financial statements. And this is because even if the commitment creates a constructive obligation, at that time the entity does not have a present obligation as a result of a past event. The present obligation is incurred only when the entity emits the greenhouse gases that it has committed to offset, that is, from 20X9 onwards. Furthermore, the entity's commitment to reduce its annual greenhouse gas emissions will not require an outflow of economic resources. Although the entity will incur expenditures to modify its manufacturing methods, it will receive other resources in exchange, so there's no net outflow of economic resources. In this example, we're also assuming that there are no other financial effects resulting from the entity's plans to reduce its Scope 1 and Scope 2 greenhouse gas emissions. So the entity must also consider whether disclosing that its transition plan had no effect on its financial position and performance, and explaining why, would constitute material information to investors. Finally, we note that if the entity has made any contractual commitments to purchase equipment by that point, it would disclose the value of those commitments, applying the requirements in IAS 16.
For purposes of preparing its sustainability-related financial disclosures, this entity would first identify its climate-related risks and then provide information about those risks. As Gustavo mentioned, there might not be a financial effect in the financial statements as a result of the entity's commitment and its transition plan. The entity would then disclose that these climate-related risks have not had a financial effect in the reporting period. Though there are no financial effects in the period, the entity would provide information regarding how it expects its financial position, financial performance, and cash flows to change over time, including relevant qualitative and quantitative information. This might include information about the planned purchase of energy-efficient equipment and carbon credits to achieve its plan, and information about planned sources of funding. In terms of our other areas of focus for this fact pattern, we have highlighted disclosure requirements related to transition plans and climate-related targets as a particular area of complementary information. For example, as part of these disclosures, the entity might disclose information about 1. Its transition plan, such as key assumptions and dependencies on which the plan relies, such as future purchases of energy-efficient equipment and carbon credits, and 2, its GHG emissions targets, which would include information about any relevant milestones, the types of greenhouse gases included in its target, and plans to use carbon credits to offset any remaining GHG emissions. We also note that, in addition to information about net targets, IFRS S2 requires an entity to provide information about associated gross emissions targets. Before I hand back to Gustavo, it is important to acknowledge that transition plans can have a pervasive effect on an entity, and in some cases it might be difficult for an entity to provide quantitative information about anticipated financial effects over the short, medium, and long term, especially for an entity that is early on in its transition journey. To accommodate for such a situation, ISSB standards have a proportionality mechanism available to entities. This mechanism requires an entity to provide information about the anticipated financial effects, but that information need not be quantitative if the entity does not have the skills, capabilities, or resources to provide such information.
Now moving on to the second reporting period we wanted to cover. By 20X5, the entity will have purchased the new energy-efficient equipment for use in its manufacturing processes. The entity would recognize those assets and depreciate them over their useful life. The entity would also disclose the additions to each related class of PP&E, as part of the carrying amount reconciliation disclosures required by IAS 16. In addition, the entity would consider whether disaggregated information about the energy-efficient equipment would constitute material information, again, in the context of the financial statements. An entity might conclude that disaggregated information is not material in that context, depending on the specific facts and circumstances. I will now turn over to Gabe to see what information about the energy-efficient equipment would be disclosed in the sustainability-related financial disclosures.
As we move to 20X5, the entity would again provide information about both the current and anticipated financial effects and other disclosures related to its transition plan progress, including its performance against its GHG emissions target. Information about current financial effects might include information about the purchases of energy-efficient equipment the entity made in the year and how they have affected the financial statements, as well as information about other related amounts, such as the carrying amount and depreciation of that equipment. We note that the possibility that the entity might have to provide that information by cross-reference, as we discussed in episode 2 of this series on example 1. Disclosure about anticipated financial effects would follow a similar theme to the initial period, though the entity might have more visibility on future costs, such as in relation to the purchase of carbon credits, now that more time has passed and the date at which the entity might be required to make these purchases is closer. In terms of other particularly complementary information for this fact pattern, an entity would also disclose information about the overall progress it has made towards its plan's objectives. This information would provide an update about how the entity is performing against its stated target and an analysis of any trends or changes to the entity's performance towards its objectives. At this point, the entity might also provide further information about the planned use of carbon credits, including information about the credibility and integrity of those credits as required by the ISSB standards. And lastly, like we noted in the previous period, ISSB standards have a proportionality mechanism available so the entity need not provide quantitative information about anticipated financial effects if it does not have the skills, capabilities, or resources available to do so. However, the relief accommodates for changes in skills and capabilities that we might expect over time, such that the quantitative information is provided when the entity has the skills, capabilities, and resources.
Now, let's take a step back and look at this example holistically. We have seen how sustainability-related financial disclosures are really complementary to the information provided in the financial statements. Even before we start to see any financial effects of climate-related commitments in the financial statements, the sustainability-related financial disclosures provide information about the transition plan, about the entity's strategy, and the actions it plans to take to reach its targets. That information allows primary users to assess whether the entity's targets are achievable and the related resources that might be necessary for the entity. And then, with time, we see in the sustainability-related financial disclosures the information about the progress the entity is making to achieve its targets and about the credibility of carbon credits that the entity is using. So together, both the financial statements and sustainability-related financial disclosures provide a holistic view of the entity and its transition plan. That brings us to the end of our webcast series on connectivity. In this webcast series, we have aimed to explain how financial statements and sustainability-related financial disclosures, prepared applying IFRS standards together, provide complementary perspectives on a reporting entity. We did so by exploring the conceptual basis for this and then bringing this to life with the examples in episodes 2 to 4. We have also emphasized our objective of providing primary users with a consistent, comprehensive, coherent, and complementary package of information, and explained how our standards are designed to work well as a package in delivering that objective. We recognize that our connected IFRS products in collaboration between IASB and ISSB colleagues are instrumental to achieving that objective. The IASB and the ISSB will continue to focus on connectivity in their respective work plans and activities. It is fundamental to everything we do. We look forward to continuing engaging with you on this area, and to help facilitate that, we have created a dedicated web page on our website to keep you informed about our connectivity-related activities and where you can find all of our connectivity-related materials, including this webcast series. We hope that this webcast series was useful to you, and we had a great time preparing and recording it. Thank you once again for joining us, and until next time.